morning. We are Mortgage Pros 411. I am Audrey Boissonou. I'm here with my co-host Kevin Casey, and we are joined today by Bill Loman. There were so many things I wanted to call you in your title, Bill. I was going to go with mortgage industry advocate or industry giant, but I could see you cringing if I said that, so I skipped it, even though I really wanted to, because I knew it would make me laugh. But anyway, how are you today, Bill?
I'm good. It's good to be here. Thanks for having me again. I always love participating in this program.
People love you too. I mean, even people who don't work for your company who might feel obligated to say something nice. People not in our company say nice things about you. So that's telling. So I just want to start with, there is a lovely event in, oh, good God, hang on, I know where it is. I'm pretty sure I know where it is. It's the CAMP's Greater Ventura chapter, and they are putting on their usual lender fair, annual lender fair, and it's really fun. I'm going to go. I go every year, and it is on Thursday, May 18th in Thousand Oaks at the Best Western. So you can Google that and figure out what the address is. But they have a whole bunch of vendors who will be peddling their wares, and you'll be able to see new ideas for loans and new lenders who there are a few people on here I've never even heard of. So that is good news. It means that not everything is going to crap. We have new lenders coming as we're losing some old lenders, right?
I'm not peddling my wares anywhere. Let's just start with that.
Well, I wouldn't bank on that, but we watched Home Point go out, which was tough because a lot of us, like I sent them a lot of loans. I really liked them. They had a great process, great people. The rates were smoking. And then all of a sudden, poof, they're gone. And I know it didn't happen overnight, but it made some of us sad. And so what is going on out there? We're seeing some people go out. We're seeing new players come in. That always happens. But we can expect more of this, I presume. And what happened with Home Point? Tell us.
Yeah. So first of all, I agree with you. I liked Home Point. I liked their leadership. I thought they were a great company, and I have a lot of respect for them. This is, I think, what, when you have United Wholesale dominating the wholesale market and, creating price wars and other things to give them a competitive advantage, they just couldn't keep up. And so ultimately led to their demise. And as we saw, they moved their origination business to a company called, I believe, the Loan Store. And Mr. Cooper's picked up all of their servicing. And, look, there's just a lot of disruption going on in the industry now. The volume pie is a lot smaller than it was a year and a half ago. And I think that, what we're seeing is, that the result of that and the competitive pressures that are being driven by United Wholesale and Rocket are making it tough for other wholesale lenders to compete.
Yeah, but isn't this where the small offices tend to shine and they kind of start to grow as they
I don't see that happening, Kevin, in this wholesale market. I don't think they have the capital to price with the big two. It was the big three. It was the big three, when Home Point was in there, and they were definitely a worthy competitor, and they tapped out, obviously. And I just think it's going to be harder. You'll see wholesalers probably being a little more niche with non-QM products or being more regional in nature. But I don't think they can compete on a national level with when United Wholesale and Rocket flex their muscles.
Here's my fear. So I understand that there are very good platforms at these two behemoths, but the problem is once their competitors are gone, they're not going to be as competitive in terms of price, et cetera. And then we all lose, and the consumer ultimately loses. And so there is danger in getting to the point where there's only two players. You don't want that. We don't want that. As an industry, we don't want that. We want the consumer to have options and to have more than one place to go, because otherwise they will jack up the prices. I mean, I would bet on it, right?
Yeah, I mean, at some point, you don't have to price like you're priced right now, right? Because
Right.
you know, your competition has gone away. You've got the market share that you want, and you know, while that's not always great for the consumer, obviously, you know, margins are really thin, and you know, it is hard for companies to stay in business today. You know, and you're seeing a lot of consolidation as a result. You know,
Right.
and it's kind of the double whammy.
Right.
It's lower volumes and thinner margins. And I know we're going to talk at some point. I'll let you drive the topics, Audrey, but that's why some of the things that we're seeing with Fannie and Freddie and these, you know, tight margins, lower volumes are really troubling. But I'll wait for you to bring that topic up.
Wow, you're being patient. That's interesting. So I'm seeing that the 2023 volume estimates are decreasing. So originally we were seeing estimates around 2 trillion in as far as closed volume for the year. Now we're down to 1.8 with some estimates that we could go to 1.4. Any thoughts on where, I mean,
You know,
and is it just due to inventory? Because again, like purchase applications last week were up 10%, refis were up 5%. And then I saw this article that bank mortgage earnings are, they got better first quarter, which I thought that was very interesting. So publicly traded banks, they posted earnings. So, you know, it's such a mixed bag out there. Like it feels like we're all over the place depending on the day, the week, and the topic, right?
yeah, you know, each and every month, I think for the last 7 or 8 months, MBA, Mortgage Bankers Association, forecast volume for the industry. And each month over the last 7 months, it's inched downward and downward and downward. And so, you know, a lot of factors. I think there's still uncertainty of where the interest rate market, you know, where the interest rates are going to settle in, or will they, you know, decline a little bit. Inventory in a lot of the big markets in the country are, you know, is challenged. So
tight.
Yeah, it is.
It's the biggest issue out there. I mean,
It is.
I can get borrowers, but I just can't. It's the challenge of getting them into houses and contract. It's just brutal.
Yeah. And Fannie Mae's consumer sentiment report just came out, and and home buyers are optimistic, which home buyers are never optimistic. If you think back, you know, when is a good time to buy? If you ask Dr. Lawrence Yoon with NAR, it's always a good time to buy. If you ask the average homeowner, they're like, it's never a good time to buy. It's either too expensive, too tight, too this, the rates are too high, it's like there's always something. So finally we have consumers who are like, all right, I'm in, right? That's good news. That's
that is good news. That is good news.
Yeah. Well, I saw an interesting, it was funny because Bill, a couple of times when I was talking to him about what we were going to talk about, he's like, where did you get that? I just want to state for the record, I do not like dial this in. I actually, you know, have facts and figures from credible sources. I'm not reading the National Enquirer to get my content.
The Star. It's a Star.
It's when you started giving me used car inventory data that I got scared. Like,
oh, well, I mean, it's part of the inflation numbers, for God's sake. Bill, get with it. Good Lord. Anyway, per Redfin, they do a survey. I didn't know this. So they survey people at 25 years old. So what percentage own houses? I thought this was fascinating. Gen X at 25 years, Gen Z, those are the babies right now. 30% of them own properties.
At age 25?
Yes. Millennials, 28% at 25, not now.
What age do people own a house?
At the age of 25. Gen X, I think that's me, 27. Baby boomers, I think that's you too. 32% owned houses at 25. They're way more affordable, blah, 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 whatever. Anyway, but the Gen Zs are at it. Can you believe that?
Yeah, when you shared that with me, I fact checked you.
After you rolled your eyes?
Yeah, well, and I did some fact checking, and congratulations, good job.
Wow.
Way to do your homework.
Oh, I'm correct. Oh my God, go figure. And by the way, just a little reminder, because almost a third of the purchases at this point are first-time home buyers. And so again, what should our focus be? What should we be doing? You talk to realtors, you put together first-time home buyer seminars, whether you do it online or in person. Try it in person, people. You'd be amazed at how much easier it is to connect with people and stay connected if they actually know you. So make sure that that's part of your plan for this year so that you are part of the 1 point whatever trillion dollars in fundings that actually do end up happening.
You know, and I want to go back to your stats about which group bought the house first at 25. There's a comment here about baby boomers parents or baby boomers parents equity. But you know what the problem was is when I was young, it was the same comment that, oh, parents have equity to give their kids. It's always been the case of parents have equity to give their kids. It's actually one of the best things I ever do is I tell clients and they're like, oh, we're really tight. And I go, well, have a conversation with their parents. I know you don't want to have the conversation, but do you know what? Most of the time when I tell people to have the conversation with their family, the family is like dying to give you money. They don't want to have their payments less than 1% in the bank account. They'd rather lend it or give it to you so that you can grow and move on. And it's like, yeah, it's so many times people go to their parents, oh my God, my parents just gave me $50,000 and it totally blows them out of the way.
And speaking of statistics, I have one around that. The average LTV in the US is 42%. Can you believe that? 42. And the average equity, that's across the country, is $185,000. That's across the country. So if you're in an area that has, slightly higher values, then we're talking about way more equity and way more available to help. So just keep that in mind. There are resources out there for people. Don't just get stuck in a loop that doesn't end up with you having any business.
I would agree.
Okay, I thought this was interesting. Bill, you might know about this since you are on the board for MBA, Mortgage Bankers Association. So the Mortgage Bankers Association, the National Association of Home Builders, and the National Association of Realtors filed an amicus brief in a pending Supreme Court case over the constitutionality of the CFPB's funding structure, arguing that any ruling shouldn't undermine other bureau regulations. This was from Sam Manis. That was, in case you'd like my source, with IMF Publications. So what they are saying is to the Supreme Court, they're saying, listen, no matter what you guys decide you're going to rule on the pending Supreme Court cases in October, make sure you don't undo the work, the regulatory work and the good work that the CFPB has done. And, which part of his good work could be argued. I understand that, but they have done some very, very important things for the industry, things like ATR, which I believe has caused things to not fall apart when times are tough, right? So anyway, isn't that fascinating? Like, did you know they were doing this, Bill? Did you write amicus brief? Did you?
I didn't write it, but I was definitely aware of it. And, look, just think of it this way, and it's kind of easy to complain about the CFPB in many ways. I get that. And if their structure is ruled unconstitutional, it would be chaos if they just disappeared in that anything that the Bureau had done and rules, regulations that they put out were to go away. Think about, TRID and disclosures and ATR, as you mentioned. And if all that goes away, it becomes the wild, wild west. And when it becomes the wild, wild west, bad actors, are the ones that usually come out during times like that. So it would be chaos for the industry if that were to happen.
Yes, it is. I mean, again, like I would love to see some of the disclosures go away because I think they're bupkis. I'd love to see us go back to the old fashioned. Remember in California, I had this magnificent good faith estimate that had just, all the fees listed. And then it had this little box that showed you exactly what your payment was, all on the same page. And then it had so much information on it. And it was so easy to read and so easy to digest, so much easier than all this other stuff. So, but ATR, I love ATR. What?
It didn't have the tip on it?
It didn't have the tip. I mean, seriously, if we polled LOs, how many of them could really explain tip? Right.
But that's what the percentage of income I get above the loan amount. It's a tip, just like the realtor, real estate agents, whatever.
Okay. Yeah.
I'm dying here. Sorry.
Okay. Yeah. His idea of I'm dying is very different than a lot of people's idea of dying.
I suddenly couldn't talk.
Very dramatic. Something, who knows what might happen. Okay.
Yeah. So I explain it's like it's when you go to a restaurant, you add the 15% tip. That's what it is.
you cheapskate. Are you serious? 50%? I mean, either you're dining at some god awful place or they hate you. And the next time you show up, they're spitting in your food.
But I like to see the shock on their face when I say that to them, because it usually says it's going to be like what's average tip these days for on a real estate transaction was like 35% or 50%. And if I say, oh yeah, that's my tip, like at a restaurant, and you just see their mouth like, what? And I know I'm joking, of course.
Oh my God. I went to an expensive dinner in San Francisco a couple months ago, and it was shocking when we got the bill, because when you talk about a large amount on a check and then they add, what is it, 20% or 25%? I mean, there's some crazy thing. And then you're not really clear. Does that include the tip? Anyway, we digress. Bill, going back to good news in the mortgage industry, let's talk about LLPAs. Well, that's not the good news. Let's talk about the DTI going away. Good job. I know NBA had something to do with that. I know that the industry really came together on this one, right?
Yeah.
I mean, it was NAMB, it was NBA or NBA, then NAMB. I don't know. Anyway, it was everybody pulling together and really opposing this. And I think they listened finally.
Yeah, I agree, Audrey. And I agree that it was everybody coming together. And I think sometimes as an industry, and when I'm speaking as the industry, I'm talking about Mortgage Bankers Association. I'm talking about National Association of Realtors. I'm talking about every association. You know, when you think about it, our interests are aligned about, I don't know, 70% of the time,
I bet it's
80%
more.
of the time.
Yep.
And I think, you know, when interests are aligned and we work together for a common good, you really can make a difference. And I think that's what happened here. And I hope, I would like to personally see all the associations that represent mortgages and housing align,
Yes.
like we did here, because I think we can get more done and we can be more powerful than, you know, than we've been in the past.
Absolutely. This idea that we're different is such a bunch of crap. I mean, honestly, because, and even I hear it at very high levels at the national level too, where, you know, somebody doesn't want to be an MBA shadow. Well, get over it, because we really need to align. And I even mentioned it to Dr. Yoon when he was on a few months ago from NAR. I'm like, we really need to come together as much as we can, sit down, figure out where do we align instead of assuming we don't, which is old news. And again, the reality is, as an LO, we need to be very interested in what is happening with mortgage bankers, because those are our lenders, whether or not you work for a retail operation, if you're a broker, those IMBs are your lenders. So it's important that they're all healthy and that you have some awareness about what's going on out there, right?
Yep, that's right. You know, what was interesting, Audrey, is that clearly last week was a win that we celebrated, where the debt ratio piece was pulled back. What then you find interesting is here we are, what, a week later? You see that FHFA is now opening up a comment period on G fees and raising other fees for Fannie and Freddie. So,
this is what we want you to translate from government talk into loan officer talk.
Well, look, it's going to be raising the fees that Fannie and Freddie, the guarantee fee, you know, or other fees, and it's raising that fee to lenders and ultimately borrowers. So what the win, you know, so, you know, it goes from one pocket that, you know, we saved out of with the debt ratio LLPA getting pulled back to, oh, but we're going to get you over here with even greater fees. So, you know, again, going back to what we were talking about, where, you know, the NAMB and NBA and National Association of Realtors, you know, need to align on how we respond and how we, you know, use this comment period to not have, you know, additional fees imposed. It kind of takes away from the win of the LLPA for debt ratio.
Totally.
It you know, if it is in fact the G fee, that's easier to operationalize than it is the debt ratio thing. So part of it was the, you know, the debt ratio LLPA was almost impossible to operationalize and not good and confusing to the consumer.
Yeah.
So
that was the selling point when we went on the Hill was, hey, this is just going to be a bait and switch for the consumer, because they're going to say, hey, I quote you 6%. Oh, but wait a minute, your DTI changed and now your rate's 7%. And nothing changed on our side. We didn't do anything illegally, but the customer is going to feel like they've been totally bait and switched. So it was a real easy sell to.
The other part too was they could no longer qualify because now they are in the middle of a transaction. I mean, it was funny. I was telling Bill that when we were in DC and Sandra Thompson is up there speaking, and they had this period where you could get up and make a comment. So I get up and make a comment, and normally I am fearless. I swear to God, I felt like my teeth were about to start chattering. I was like, ugh. And I think it was more a few of the people in the room I know are not terribly friendly. And so then the fact that it was Sandra Thompson, but I was telling her, I said, we don't use this irresponsibly. We don't put someone into a 50% DTI if we don't know that there is some other income that we aren't able to count in their DTI, but it exists. And so we know, I mean, good loan officers, which are most of us, we are actually inquiring and finding out about our clients' lives. Like, are you going to be able to make your payment is a part of the conversation. Just doesn't matter what the DTI is. So how are you with this payment? How are you going to manage your life? That is the conversation. And so, I mean, I was looking her in the eyes, I was telling this story, and I'm like, it felt good. It feels good to be able to participate in the conversation. There is no one person or entity that does anything. It's everyone coming together. I think the more we can remember that, the better. But back to this G-fee thing. I mean, I didn't look up. I always get so angry when I see their profits, Fannie and Freddie's profits for the quarters. And I meant to go back and look at first quarter profits. They, as everyone else was sucking wind in 2022, they still posted huge profits. So they are so completely focused on becoming, getting, Bill, help me here.
Well,
It's
so
nuts.
Don't read the press release, because what FHFA says is that Fannie and Freddie aren't making the profits that a commercial entity would make. So look, this is, and one of the great things about, this show is everybody that I think, spends the time to attend the show are industry participants, and they're active. And I think we all got to pay very close attention to what's going to be going on over the next few months as a result of this comment period and the fees that they're looking to raise.
Look at this. This is their quote. They noted that Fannie and Freddie are not currently earning commercially reasonable aggregate returns on new single-family mortgage acquisitions when examined under the Enterprise Regulatory Capital Framework. The framework, and this is a part that super pisses me off, the framework, which was crafted by the FHFA under the direction of Mark Calabria, an appointee of the Trump administration, fully took effect in 2022. So they're making it political just to like rile everyone up, right? And so, okay, they're doing the same thing he was doing. How is it different? Like, is it different? Am I missing something? Tell me if I'm missing something.
It's not different.
It's the same thing he was doing. They're doing, only they want to raise the fee some more. I'm like, oh my God. So, okay, so here's
but he was Republican. They're Democrats. They don't want to make more money.
I don't care which side it is. That's the whole point. I don't care. They're both doing the same thing. So get over yourselves, right? Okay, here's my question from the LO perspective. Is there something we can do as LLOs to participate in this conversation? And I don't mean, writing letters that say G fees are stupid. No, I'm like, how does increasing all of this in the face of, we've had this crazy high interest rate environment, the interest rates as inflation is coming down should be following suit, and instead, they're going to raise the G fees, keep the rates up. It's just so messed up, Bill. What do we do? Can we as LOs do something?
Well, I think, being active in your associations is obviously important. And I think the thing that, we need to emphasize as an industry is, look, it's been all about getting people into homes. It's been all about affordability. It's all of that. And what this is simply going to do is raise payments to consumers. It's going to put a further drag on us, you know, the industry pulling out of this spiral that we're seeing, you know, like we started the show today. Every month, the industry forecast goes lower, 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 lower. Well, this isn't going to help. This isn't going to help people get into homes. This isn't going to help affordability. And we have to, you know, as an industry, rally behind all of that. And I think the important thing that, you know, was important when we got our win with the debt ratio LLPA is this has to be about the consumer. You know, if we're, you know, one of the things that I thought was really important when we were lobbying against that is like, don't make it about the lender or necessarily the inconvenience for the lender or how this is going to affect the lender. How is it going to affect the consumer? How is it going to affect getting consumers into homes? And that's what makes everybody listen. That's what will get the attention of the regulators.
Right. Exactly. And it just runs completely counter to their supposed mission and this helping the underserved. It's just a bunch of hooey from it when you see this kind of action. Okay, so I have heard from a number of lenders, and I'm hoping you can shed some light on this. We talked about it a few months ago. There had been a little silence since then. And then I heard a weird conversation the other day on another podcast where someone said something counter to what I thought was going on. Buybacks from the GSEs. What's going on with those? Because are they increasing? Are they not increasing? What are they an issue? Or are they not an issue? What's going on with buybacks? And just to be clear, explain what buybacks are to start.
I'm going to say.
So I suspect that I can't say no comment.
Oh God, no.
Yeah, no.
Oh God, no.
So
we can make comments for you though. We think they're terrible.
Oh, we will put words in your mouth if necessary, but let's hear it from you, Bill.
Okay, so a buyback is when a lender has to repurchase a loan that has been delivered either to Fannie, Freddie, or an aggregator. And it's typically you're asked to buy back the loan or repurchase the loan when you know, a QC is done. They review the loan. The agencies review the loan. They deem it ineligible for whatever mistake, and mistakes can be egregious. Mistakes can be what I like to call foot faults, which are, you know, not necessarily egregious. So just to walk you through the whole process, what happens is we deliver a loan to the agencies. At some point in time, they QC a certain percentage of your loans. They see what they think is a mistake. They send what is called a deficiency letter. The lender gets the deficiency letter and responds. It goes back to the loan file and either cures it or gives some form of response. That gets sent back to the agencies, at which point they say, and they are the judge and jury, by the way, they say, nope, not good enough. This loan, the income is calculated incorrectly. The debt ratio is 54%. That renders it ineligible. You buy back the loan. So let's just say we did a $400,000 loan. We then buy back the loan. We write a check to get the loan back to us for $400,000. Now it's sitting on our books, our balance sheet. And I'll just tell you that independent mortgage bankers, you know, we're not in business to hold loans. We have to sell our loans. And so, you know, the more these you get, the more problematic it is. At that point in time, as a lender, you either try to, more often than not, either refinance it or sell it in what's called the scratch and dent market, which is where an investor will buy the loan at a steep discount.
So what would they pay for that $400,000 loan?
Right now, let's just say 75 to 80% of that $400,000. And so of that $400,000.
Get your calculators out, people.
So you lend the 400,000.
Yeah.
And you paid how many $1,000s in fees to your loan officers and everything to get.
Yep, all that money is out. And so then I get $320,000 for a $400,000 loan, and I have an $80,000 loss plus whatever the cost I sunk to make the loan the first time. So couple things on that, which is problematic. One is the agencies are behind in QCing, and I think they're smelling blood, and they are doing a lot of reviews of loans from 2021, where highest volume year ever. Perhaps mistakes were made, maybe foot faults were made, but they're going back to 2021. Now think of this. One of my options is to refinance the loan or to scratch and dent it. These loans were made at 3% or 3.5%.
Right.
Market is 6.5%.
Can't get 3% these days.
Which is a big, so I can't really refinance that loan. Who's going to go? Borrower is going to go from 3% to 6.5%, and that is driving, these deep discounts from scratch and dent investors who want a discount to that yield. So that's why you're seeing, being 65 cents on a dollar, 70 cents on a dollar. And so that's the process. And to answer the very first question was, are we seeing more and more of these? Yes, we are. All lenders are seeing them. And, obviously I can speak from, our own experience, but being, an active participant in the MBA, you have a lot of friends who, are running different mortgage companies, and everybody is seeing it. Everybody is seeing more. So one of the things that is really problematic about this is these loans are performing. So for example, you might get a loan that was done towards the end of 2021. The number one reason loans are being asked, lenders are being asked to repurchase, the number one reason is income, and how the income was calculated. The number two reason is around appraisals. So, wow. It's you get this repurchase, and the borrowers, from a year and a half ago, and the borrowers made 18 consecutive great payments.
Right.
But you still have to repurchase this loan. One of the things that, and then I'll say one more thing and then stop talking, and I know you guys will, have some good questions. One of the things that Director Thompson said 2 years ago is they don't want to push back that, repurchases to lenders. They want to offer lenders alternatives to repurchase. What would an alternative be? We as a lender could pay a small fee and indemnify the loan, which they will allow sometimes, but we're not seeing it today. And what does an indemnification mean? I may, write a check for $10,000 and indemnify the loan, which means if the loan ever goes into default, I agree to repurchase it. But as long as the borrower continues to pay, it doesn't come back. And that's a good alternative to purchase.
Yeah, great.
The other thing that you could do, or they say they would do, but they're not, is maybe there are additional fees the lender could charge, which is almost like risk-based pricing. It's like, okay, so this loan, I agree, we messed up the income calculation. It's like paying a post-closing LLPA, but offer these things when the loan's performing, when the borrower is making payments, because pushing these back to lenders is just harmful. Like you said, there's like a $400,000 loan. It costs you $80,000 to scratch and dent that loan. While we're all looking at our P&Ls, we're all adapting to lower volumes. We're all trying to adapt our staffing, and all that. It's like, how many people are going to lose their jobs because Fannie and Freddie won't offer an alternative to repurchase? And I'm not, I'm speaking to the entire industry right now.
So it's a financial flogging versus maybe they should offer a spanking option, for God's sake.
Yeah, for sure.
Like, what the heck? Okay, so here's a question about the income, because we're doing a lot of, and there's a real push towards using AI and to calculate income. So the income that was calculated incorrectly, was it done by humans or was it done by an automated system? And if there is an AI involved in the calculation of income, who's responsible then? Does the company providing the AI, do they provide some sort of guarantee? Like, how does that work?
So some do and some don't. So in a lot of these instances, it is a human that, makes a mistake. And when you look at these loans, where you may see this, it's tough for AI to underwrite certain self-employed borrowers, right? Because that's always a challenge in underwriting the income, or overtime, or things that are just outside, a normal wage is where you get it. So there are tools, and we use one at American Pacific, and if it renders a decision on and the income and you get a repurchase, part of the fee you pay to the vendor is insurance. So you get they participate in buying the loan back, and some do and some don't. And I think it depends on the cost structure that you choose with that AI vendor. You
Seems
pay
like it
more,
might be
you
worth
get
it to get the insurance.
Right now, it sure is.
Yeah. Oh my God. So, okay. So we have a comment from Monique saying using AI to calculate income is just ridiculous, but I'm just telling you, it's happening out there. It is the wave of the future. And I'm also hearing that the AI is getting much better on self-employed and rental properties as well, where before it wasn't. And so that's shifting as we speak. My conversations with non-QM lenders are that they don't think that non-QM is going to go that direction, and that Wall Street doesn't have it. That's not what they're looking for. But for conventional loans, what's your feeling on that, Bill? It's happening, right?
It's happening as we speak.
Yep.
And I guess personally, you got mixed feelings about it, because it's, you, to the extent that you're replacing people with technology, it's like, culturally, how does that fit? That all being said, as an industry, and going back to what we were saying earlier about thinner margins, right? We've got to reduce the cost to originate. The cost to originate a loan has gone up for, every quarter for, I think 8 years straight, some ridiculous number. And we got to get the cost to produce down. Because that ultimately is how, we best serve the consumer.
It is, but I've had this conversation with some of my tech friends. We kind of go around and around about it, because I hear people, like usually old guys at MBA talking about LO comp, which always irritates the crap out of me, because LO comp, like, I'm not making more than I used to make. Like, my percentage of the loan is not different than it used to be. In fact, I actually make a little less now than I used to. And so I'm not the problem. Let's just get real. The problem is we have all these other costs, right? So we have tech. Tech should be making everything easier, less expensive. Is it? I don't know. It does on the one hand, but the cost, I want to see can I see your P&L, Bill? I'd really like to see a breakdown of where this cost per loan is coming from. And I think we should do an analysis together, because then maybe we could get some answers. I think that there is something going on that we don't understand. Why is the cost going up so exponentially? Regulation, I know that's a biggie. And I had a little chat with our friends at the CFPB telling them there should be an ROI that is calculated, and they should have to validate the value to the borrower before they implement some new regulation the borrower is going to ultimately have to pay for. And so I don't know that they're on board yet on this idea, but I'm going to keep at it. Don't you worry. But again, like, what are the costs that are being driven up? Tell us all about it.
So, I'm going to stay away from LL comp, clearly. But look at it this way. When you think back, you just said, your comp as a loan officer hasn't changed in years and years and years, right? Well, go back 10 years, 12 years. How many loans per day did an underwriter do?
Okay, great question.
And let's say it was 6. Today, it's barely 2.
Okay.
So fulfillment
What is
cost
causing that?
is
We have,
huge.
we have AI that's calculating half the income. We have loans that have PIWs and waivers all over the place. Why is that? What is happening that they are able to
They
do?
can only do
something
2
less?
now.
Exactly what we just talked about. So you have AI, you have all this, but lenders, we all have increased repurchases coming
Yes.
back from the agency. So what do I
Is
got
that
to do?
calculated into that number?
You got to
Dot
hire
the I's, cross the
the
T's.
checker.
Yes.
And the repurchases that we're talking about didn't just start yesterday, the increase in them. This has been going on, and it's kind of almost been an insidious increase over about the past year or so. But you look at, using the example of all the regulation that has been put into our manufacturing process over the last 10 years and the compliance that has needed to go into our manufacturing process. Because, if you stub your toe on a disclosure, you could potentially be, you can't sell the loan or you have to repurchase the loan. So all of these things create friction in the manufacturing process because you got to get it right.
And sometimes it's crazy stuff. I mean, I had one, I remember where the client bought a house, it was a 2-unit property, and fully disclosed, appraisal came in at 2 units, everything was done. And then after the close of escrow, the investor came back and said the property is zoned 3 units, and they don't do loans on 3-unit properties. I'm like, well, you don't do loans on lots either. If the building burnt down, you'd have a lot. So I don't know what you're complaining about. The property is a 2-unit building. Just because the zoning says you can build 3 units doesn't mean it is 3 units. What were we supposed to do? And I don't remember if it was APM, whoever it was I was working at the time, but ended up having to buy back the loan, and probably got killed on the selling it as scratch and dents when the underwriter didn't do anything wrong. I didn't do anything wrong. The borrower didn't do anything wrong, but the investor just came back and said, oh, well, we're going to consider this a 3-unit building, even though it's
So
not.
Kevin, I would respectfully just disagree. And Bill, I think we found our problem. It's Kevin's loans.
Right. Wow. So these are all examples. And look, here's the other thing. And, and every company is different in how much they trust and rely on AI. But because it is so new in decision making and rendering decisions for, mortgage companies, you're not completely trusting it, right? Or as a
Right.
lender, you may not be completely trusting it. So yeah, okay, I got this AI decision, but now I've got to have 8 people look at it just to double check it and make sure. So all of these things are increases over the last 10 years in, the manufacturing process for the cost for manufacturing alone. And so there's a lot of that. I didn't even say LO comp. I want you to get paid everything that you're worth.
I will say that you have never said such a thing. Otherwise, I'd slap the crap out of you. But
I wouldn't be on the show.
yeah, there's so many bad things that would happen. So yes. Okay. So Bill had a different Bill, not you. You're not asking questions for yourself, just to be clear. He was asking regarding buybacks, how far back can the GSEs go? That's a great question. Is there like a statute of limitations on buybacks?
So yes and no. So generally speaking, they'll go back 3 years.
Oh, good God.
Okay. If there is fraud or misrepresentation, that can be the life of the loan.
Wow. Okay. Well, that makes sense, actually. Oh my goodness.
So actually,
Kevin, Grant is commiserating with you. He says he's really sorry about your problem.
Yeah, I know how it is. Hey, I mean, the deal closed. I'm just sure the best, whoever I was working for at the time that kind of posed on that particular deal, as I remember. I read a great book one time, and it was about running a business, and they gave the example of a restaurant where the waiter drops the plate with the steak on it as he's coming out of the kitchen. And they said it was really eye-opening for the employees to realize how many other steak dishes have to be made after that to make up for the loss of the one steak dinner. And you know, you ask them, oh, well, we make it up with 2 or 3, and then they realize, oh no, we have to serve 25 steak dishes to make up for the one that we lost. I think in the lending world, I think that's an important stat. It's like, how many loans do you have to make up for the loss on the one that gets bought back?
Yeah, that's exactly right. So, you know, first of all, every restaurant should follow the 5-second rule. Like, clean it up, wipe it off, and put it on a fresh plate. If it's only been on the ground for 5 seconds. But sure, I mean, you know, look at the example we use on a scratch and dent loan, and that's, you know, if you lose $80,000 or $100,000 on an average loan, you know, and the average income, you know, you probably got to make 15 or 20 loans to make up for that.
Yeah, that's a lot. That's a
Yep.
lot of business to make up. And then what percentage of them are they scratching and denting right now?
Well, that's up to the lender like us to make the decision whether to try to refinance, try to scratch and dent it, or hold on to it. I
Or
think
hold on.
so. To a certain degree, to the extent that you have the cash, you'll see lenders, you know, hold on to it for a little bit in case there's a rebound in the interest rate market.
Right.
And if, you know, the prevailing rate went from 6.5 to 5.5, you would save a lot of money in,
Exactly.
or you wouldn't save a lot of money. You would lose less money.
Yeah, okay. So speaking of losing less money, I hear the market is priced in 3/4 of a point drop in rates between now and the end of the year. Yet the Fed is not talking about dropping rates 0.75% between now and the end of the year. How's that supposed to wash out?
Boy, who knows, right? So
yeah, I'm like, wow.
I think it's, you know, I saw a stat where I think there was somebody put an 80% likelihood that the Fed would not raise rates the rest of the year. I'm not an economist, by the way, but I would put it at 50-50. I think, you know, while the inflation, you know, inflation seems to be decelerating, I guess.
Yeah.
Is, you know, the road down on inflation is always really choppy and crooked. And so I'm not 100% convinced that we won't see another
increase.
But who knows, man? That's a tough one.
It is. I mean, it was interesting because, you know, at first everyone was predicting, oh, they're going to go up and they're going to come right back down again. I don't see them coming back down anytime in the short run. I'd say we're going to be flat for a bit here, maybe through the end of the year as far as mortgage rates. But
yeah.
Welcome back, Audrey.
Thanks.
We got to talk about you while you were gone.
I'm
All
sure
sorts of good stuff. We passed back and forth. You'll have to watch the YouTube video to see what we talked about.
Oh my God, no way. I don't even want to know. Thank God for hotspots. That's all I got to say. So I thought this was interesting. So I know that new home building is only, usually it's a little higher now, but little like 10% of the market. But the chief economist for the National Association of Home Builders, Robert Dietz, said, how do we solve the lack of inventory? We've got to build more homes, right? Of course, but that's more complicated now due to the higher rates. Acquisition, development, and construction loans are very high at 11 to 12%. By raising interest rates, the Fed made it more expensive to buy and develop housing. Regulatory costs also inhibit housing inventory improvements. It's death by 1,000 cuts. It's impossible to build entry-level housing when you've got, before putting a shovel in the ground, $200,000 in regulatory costs. More inventory is a solution. It's coming, but not fast enough. Any idea on how we get around this, Bill?
Yeah,
I mean, we've had inventory. That's our number one problem right now. It's more than rates. It's worse than rates. What do we do?
Well, I mean, and think of it this way, and the operative statement there was it's $200,000 before you even stick a shovel in the ground. Well, if it's going to cost you $200,000, are you going to build an 1,800 square foot, you know, starter home for somebody, or are you going to build a 4,500 square foot, you know, larger home? Because the 200,000 is the 200,000. So that's why you're seeing that. What, you know, look, I think the solution, I think you're going to see a lot more, you know, alternative living units that, you know, need to become more mainstream, need to become more liquid. When I say liquid, lending guidelines that are conducive and not, making you jump through hoops to be able to lend on that unit, or manufactured housing, or certain modular homes, or cross mods, just different properties like that, property types, because it's not going to be that, you're just going to have the $200,000 to stick a shovel in the ground is just a limiting factor that will not be overcome. So we need to look at alternative housing.
Okay, so here's the problem with that from my perspective, and then you can tell me how I'm wrong. So the cohort that's trying to buy houses right now, millennials and presumably Gen Zers, I always mix up Z and X, but anyway, the youngins, they don't want to live in a shipping container. They want to have families and they have children. I know, shocking. And they want to have houses, yards. They want places for their children to go out and play. I mean, after COVID, we know that the whole dynamic had changed. You walk into a property, you look around, you're like, so could I live here during lockdown? And then could I live with you here during lockdown, right? So it's shifted. And so we have a lot of 1-bedroom condos that are empty in San Francisco because they had to build them because it's required by the state to have affordable housing and low-income housing, but we're not building what people want to live in. And I've heard NAR talk out of both sides of their mouth on this. On the one hand, they acknowledge that people want to live in houses with yards. And then on the other side, they're like, well, we need to have affordable housing and we'll have to build all this other stuff and blah, blah, blah. So what do we do, Bill?
Look, both things can be true, right? So they don't want that, right? But if it doesn't exist, if the stock doesn't exist, if the inventory isn't there, what are you going to do? And I think it's going to take, like people on this call, industry experts, people that can educate the youngins, like you described them, on the value of owning something, and how that can bring them and they can build wealth, even though it's not the most desirable property to them. And that will help them get into a less affordable new home because nothing's affordable.
Yeah, well, okay, so Monique made the comment, this past weekend, I visited new construction. The Melrose fees of new homes development south in Orange County are causing the property taxes to be at a level of 1.5 to 1.9% for new homes entry level at $900,000. Yikes. Yikes is right, Monique. Yeah, exactly. I'm sure we can edit that out. Don't worry about it. We also we have Dirk Nelson, who's back listening, he often makes really funny comments. Today, I'm afraid that the January 6th committee would come and arrest me if I repeated it. But his solution has something to do with enticing politicians to make better choices with regards to some of the legislation. I'll just leave it at that. Okay. Okay. So do you know that we are nearing $1 trillion on did you get that? Did you get that?
I did. Austin Powers, I get it.
Thank you. $1 trillion in credit card debt. This is not a great thing for anyone who has credit card debt. You know what it is?
Especially if it's one person has it all.
It is, well, yeah, we don't even start with that, but it is an opportunity, people. So you talk to somebody and they say, oh, I have a 3% rate. I don't want to touch that. And then you say, hey, you have $60,000 in credit card debt and half of it is at 29.99%. Do a cost analysis, for God's sake, please. I keep saying this, but I'm going to keep saying it because it really matters. So yes, they might have a low rate on their
mortgage,
but I have heard stories of people have saved people $3,000 recently by putting them in a higher rate on their house and getting rid of all the consumer debt that's at such a high rate. So make sure you're looking at that. It's an opportunity for us to help people and to close some loans.
That's a great idea. Hey, Bill, I got a quick thing to throw by. NARD had a bill drop last week to increase the capital gain exclusion on home sales from $500,000 for a couple to $1 million. Have you heard about this and any thoughts?
Just what you said. I mean, and nothing more on that. I thought that was interesting. It was like, okay.
Yeah, I thought it might, take some more houses to get them on the market because people now are more willing to sell their house into the, an extra property. But then I did the math. It only saves you about $75,000 in federal taxes. Maybe a
I
little-
almost punched him when he said that. It only
Well,
saved
yeah.
$75,000. I'm like, are you
Apparently
kidding?
Kevin's doing so well.
Yeah,
writing
Kevin's
shitty-
killing it right now.
writing
$70,000.
shitty- we gotta look at his LL comp. Jesus. He's the one that we need to worry about.
Oh God. Oh my God. Okay. So lastly, and I don't want to miss out on this, and I know this is a tough one, so I will be gentle. Jumbo loans, because we have lost wells, and we talked about it a couple weeks ago. First Republic went out, they were number 4 jumbo lender in 2022, and they're not doing bupkis at this point. So with that being said, where do we go with our jumbo loans, Bill Loman?
So, just to go back and put a little context on why among the reasons of the jumbo challenge, obviously Wells getting a huge challenge. For the first time in, I don't know how long, years and years and years, the actual number of deposits in our banks has decreased. And lenders typically will allocate a certain percentage of their balance sheet, AKA deposits, to jumbo lending. And so that's shrinking. You're seeing the appetite for jumbo loans shrink. You're seeing the big banks get out, like Wells. You're seeing regional banks scare the crap out of everybody. And they saw what happened with, First Republic. And so there's not a lot of supply of lenders. I will tell you that I would say, there's a lot of us in the industry that are going to the MBA meeting, the secondary marketing meeting conference in New York next week. It's number 1 on a lot of our lists to try to network and find out who the hell's doing what, because we do need replacements there. Over the last year or two, of the investors that mortgage bankers sell to, Citibank has gotten more aggressive with their pricing and appetite. And recently, like just really within the last week or two, we have seen Chase get more aggressive with their pricing. So they would put themselves on the sidelines for, most of 2 years now. And prior to that, they were the number 1 jumbo investor for mortgage bankers to sell to in the country. And so we're seeing them increase their appetite a little bit, improve their pricing. And again, I'm looking forward to meeting with them. All lenders that are, going to be going to this are on the hunt for that product. So,
well, and unless if you're a broker and you're thinking, well, I don't work for a retail operation, I can't send loans to Chase and Citi. Your wholesale lenders are using Chase and Citi on the back end. So find them. So ask your reps who their investors are, because they can help you with this little conundrum.
Yeah.
So,
well, the interesting thing though, some of these, not Citi, but Chase doesn't take wholesale businthat. So if it was
really,
that was the case. That's been the case for a number of years. So that might be an impediment to some of the people on the call that are looking to deliver to Chase or have their wholesaler deliver to Chase.
Okay, so I will. Okay, so in answer to the overall question, we'll stay in touch with you and with others who have information on who the investors are that we should be looking at. That's good to know about Chase. I didn't realize that, little boogers. So there you go. We will, and we are over. I knew this was going to happen today, and you're going to run out of time before we ran out of things to talk about. So we love you, Bill, very, very much. We will look forward to having you on again. Keep us posted on what you're finding out.
Yep, always great to be here.
Yeah, absolutely wonderful. And next week we are going to have Anthony Hutchinson, formerly of Freddie Mac, where I was not allowed to talk to his algorithm people, currently with Vantage Credit Scores. And I am apparently going to be able to talk to his algorithm people. He has promised me. So we'll see how that goes. He's going to teach us what we have coming with regards to how credit scores are changing, and they are going to be
Changing.
changing. We have a little time, but we need to make sure that we have our borrowers ready, because if you have a 780 score right now, you might not at under the new guidelines. New guidelines, is that the right way to put it? Probably not. Anyway, the new scoring model. So, and we have a thank you from some people. Bill, everyone appreciates you and all of your knowledge. So with that, guys, we'll see you next Tuesday, 11 a.m. Pacific time, 2 p.m. Eastern time, or on our YouTube channel, Mortgage Pros 411. Mwah! Bye, guys.
Bye, thank you.
Thank you, Audrey.
See you on Thursday in Thousand Oaks. Bye.